Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, income tax planning for executives and business owners. Part 1 in our series on financial security through tax advantage strategies with nationally recognized retirement authority, Charlie Day. Welcome to the show, Charlie.
Well, thank you, Steve.
Charlie, every exec that I know wants benefits. I mean, once you get past salary, once you get past your expected bonus, if you hit certain performance levels, everybody's saying, what else you got for me?
Right.
Benefits. And especially for business owners who say, gee, I have to be, I can't be discriminatory towards 401k participants. There's other areas, though, that I could be a little bit more discriminatory so that I could benefit personally as the owner.
Well, the code allows us to design a lot of interesting approaches to creating fundamental financial security. The universe out there is basically divided between what I call lump sum focus plans. This would be 401k plans, profit sharing plans, cash balance plans, any type of plan where the participant has a right to the assets. Mm-hmm. And then there is the more profound financial security type plan, which is benefit focused. Mm-hmm. And the code gives more emphasis to those type of plans that are benefit-based in terms of the amount of value and benefits that you can derive, as well as the magnitude of deductions.
Now, most of us that are thinking of retirement, I'm just thinking of income, but when you say benefits, you're talking about extra benefits above and beyond traditional income.
Yes.
So give me one benefit.
Well, for example, when I was at Cigna, we designed defined benefit plans for large corporations. And in those plans, we provided a pension income stream for both the participant and the spouse as long as they live. In other words, that's fundamental financial security, isn't it? Mm-hmm. In addition, we would provide both a pre- and post-retirement death benefit. We would provide post-retirement medical. And in today's environment, that's pretty critical.
So those things are, because those things are extra, is this where the IRS allows a greater contribution?
Yes.
Okay,
but
so
it's in those plan benefit focused type plans that you can have these additional values, these additional benefits, and you're able to put a lot more money in because it's the emphasis is on receiving benefits, not a capital sum of money.
Now, Charlie, I just want to tell our audience, of course, you are a member of the American Academy of Actuaries. You're an enrolled actuary. So you're really into the science of this, and we have to actually test these defined benefit programs that have these extra benefits through an actuarial assumption so we can figure out what our contribution is.
Yeah, my job is to certify to the government what the plan operation is, both in form and substance, and certify to the government that the deduction that the client's taken is valid. That's what an enrolled actuary is.
In your opinion, you've been in the business, I mean, you're one of our patriarchs, no doubt about it. How many business owners and executives are looking for these substantial side benefits that are really not in traditional defined benefit plans?
Well, it's funny because most of my colleagues out there are marketing lump sum based plans. And I created a business model from my experience at Cigna, taking the principles of very large plans and bringing them down to the small business owner market.
Any extra costs for doing a plan like this?
Yes.
So
it's more expensive. It's more technical.
But the benefits outweigh the expenses that
Absolutely. I mean, on a magnitude of 2 to 3 times.
So it's substantially, it's substantially good. When they go through the decision-making process, which we're going to talk later on in the show, you have certain benchmarks, talking points that you have to go through to make sure, hey, this is a good decision so they feel comfortable because they are laying out a little bit more money than the conventional retirement plan.
Yes. We walk the client through the lump sum focused approach and then through the benefit focused approach so they can have a sense of the comparative values and commitments that they entail.
Now, I want to go to this second slide here because I want you to talk to me about the GAC treaty. You know, PPA redrew its own map in 2006. The government kind of repriced it. But I don't know if anybody understood the GATT treaty as it works with the 2006 PPA. Talk a little bit about this because this is important for a business owner and or an executive to look at.
GATT had a pension provision that basically said that if you have a lump sum based plan, there is a statutory cap above which you would be subject to a 50% excise tax. In other words, the assets cannot be above the value, the actuarial value of the maximum benefit under the code. And the reason for this was up through 1994, Treasury was trying to audit small plans because they were, in their mind, overfunded, having low assumptions and high rates of return. And the IRS lost in 3 Federal Circuit Court of Appeals. And so the Treasury went to Congress and said, hey, we need a provision, and we stuck it into the GATT treaty, that said, if your value of your benefit exceeds this dollar amount derived from the IRS actuarial table and the Treasury discount rate, how we value the benefit, you are overfunded. So the term overfunded is a statutory term. It applies to defined benefit plans that are lump sum based, where the participant has a right to the asset. And it was in 1994 that I created my firm, which developed the benefit focus plan because it's not subject to GATT. Well, fast forward to 2006, they applied the same actuarial calculations to all plans. And in that law, they codified post-retirement death benefits, they codified large plans, small plans, they all are subject to the same actuarial calculation. So any actuary doing a proposal for a client should be coming up with the very same numbers because the methodologies have to be used by the actuary to determine the deduction maximums and minimums under the law.
So this is really good, kind of updating the regs on this issue, and you took advantage of seeing where there was a gap, or let's say maybe an option here, that nobody was taking before.
Well, what I saw was the GATT problem put a cap on what people can accumulate under a defined benefit plan. And so that exposed them all to this 50% excise tax. And I said, why would you put your client in that position when what's the primary purpose of the plan is to provide fundamental financial security? Most people are married. So why don't you create a resource that you can't outlive? And GATT doesn't apply to benefit-based plans. It only applies to lump sum-based plans. So, and then from that springs a lot of other values and benefits.
Now, I noticed that you have a strong legal on this. I've read your brief, and it sounds like this is not a gray area of the code. This isn't elasticity of our thinking. This is down the middle, pretty much mainstream thinking, except for that not many people do it.
Right, exactly. Our platform is based on 4 fundamental legs of a stool. One leg is that the participant doesn't have a right to assets, only a right to benefits. As a result, we can fund to the most valuable benefit under the code 100% joint and survivor annuity. So the maximum benefit that you can have under the code is like $215,000 annual monthly benefit beginning at age 62. Well, the amount of money under a lump sum focus plan, as you'll see a little later here, you're going to run out of money by the time you live your life expectancy. And if I can fund to a joint and survivor benefit, I'm not going to run out of money. I have enough to take care of both Ma and me for as long as either one of us live. Third leg is all the work that we did with our law firm a major international law firm, their chief ERISA attorney, analyzed all the regs providing for a post-retirement death benefit. And to their surprise, there was nothing negative in the code about it. Then the fourth leg is the power of our volume submitter. It has standing, and the standing has been reinforced by major court decisions against the IRS, where the IRS tried to reverse the power of a volume submitter, letter of determination from the IRS. And from that, we have had our law firm provide a letter of opinion outlining all these sections of the code, putting us on very strong ground. And we've been doing this now since 1994. We've had clients audited, and those audits resulted in no changes.
Well, don't forget to watch our next segment on retirement planning for executives and business owners, part 2 in our series on financial security through tax advantage strategies. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.